Hello everyone, so in today's video we're going to be looking at how we forecast buy-to-let properties. Now there's different forecast sheets for different strategies that we use internally within our own business, and today I just want to show you really the sheet that we use specifically for buy-to-let and how you can use this when considering your own deals. Now down at the bottom here we've got three main tabs. We've got a rentals tab, a flip tab and a stamp duty and tax calculation tab as well. Now, the reason why we have these two tabs here is because ultimately the main aim for buy-to-let will be as a long-term buy and hold portfolio. However, it is important to have a plan B and understand if for any reason you did need or want to sell that property at any stage in the future, what the figures might look like to consider for that. As you scroll up here, we'll go through each tab kind of at the beginning stages. As you can scroll up here, at the top we've got property name. Now you can put in here anything you like. We usually prefer here to put the property address, so if it's number 1 High Street or whatever address there kind of might be. Ideally the full address including postcode, then you've got that for context later on. Simply for this video we're just going to be looking at the main detail of this property to give some context to the specific use case. Let's say for a 3-bedroom semi-detached house in a given area in the northwest. There's also a comment section here which you can add in additional kind of information. So this is quite handy if you want to put some extra detail about maybe how your viewing went, if you've already viewed the property, or what you want to consider on any upcoming viewings. Also any potential ideas and thoughts on possibly the refurbishment. Anything that might impact your forecasting of this kind of given deal. When we click on flip tag, you can see here the property information will come across. So if you've put in here the address, that will again show here at the top. And then when you click on stamp duty land tax, this is primarily all the information stripped out apart from the stamp duty element. Now for stamp duty, the majority of properties that we look at, especially for buy-to-let, are going to be mainstream residential property. Now there is different stamp duties payable on residential property than there is on commercial property. So if you were to buy commercial property, your stamp duty levels here would be slightly different and you wouldn't have this premium section either. So to give some context and explanation just specifically on stamp duty right now, I'll put a link below this video to the stamp duty kind of guidelines within the government kind of website. But as a breakdown, stamp duty is worked on a banding system. So you'll have certain price ranges. So for example, on residential property up to £125,000 in valuation. You wouldn't pay any stamp duty if you were buying that as a main residential home. And then as you can see, there's a banding increases up to 250,000, you'd have a 2% stamp duty to pay. Now this is levied between the difference of each band. So for example, if you purchased a property for 130,000, you'd only pay this 2% stamp duty on the £5,000 difference. You wouldn't pay any stamp duty up to the first £125,000. Hope that makes sense. Specifically on this calculation, this purchase price here is being pulled in from the very first tab, this rentals tab section here. So all of this will be automated and then it will calculate the stamp duty payable and then it'll take that information back to the first tab as well and also back to this second tab for you. Now when it comes to buying investment property, so usually if that's via a limited company and or if it's your second property purchase, so you're buying it as a buy-to-let rather than a homeowner, you have a stamp duty premium now payable on those properties. So this is only payable because you're buying it as an investment property. If a homeowner is buying the property, they wouldn't have this premium payable. And this premium is in addition to whatever these stamp duty levies are above here. So if you're buying a property for 100,000, for example, it will fall below the original threshold, so you wouldn't pay any stamp duty on that calculation, but you do have potentially still a 3% premium to add, and that's calculated here, hence the stamp duty is 3,000. Below here we've got a worst case and possible case and a best case scenario. If we go back to sheet 1, that's because here we have 3 columns for those valuations. Specifically on this sheet, here, you'll have stamp duty auto-populated into these columns based on a best possible and worst case scenario. That's taking the figure here from your purchase price in any of these column cells, figuring out the stamp duty here, bringing the information back to this cell here. Hopefully that makes sense. Of course, if there's any questions throughout any of these forecasting videos, simply put a message in the comments section, drop me an email, always happy to help. Now, as we go down these columns, I'll go through the possible case scenario ultimately on this particular deal. But just to give some explanation on the worst case and best case scenario, we have these rows and columns in here effectively as well, is because it just allows us a very easy snapshot to see how a deal might work if we were to look at the different use cases of that property. So maybe it costs more to buy it. So we're just in the negotiation phase at the moment, potentially. I hope to buy it for 100,000, but maybe we can't pick it up for anything less than 105, or maybe we do really well and we're able to pick it up for 95,000. That then follows throughout the rest of this sheet. Costs of refurbishment, for example, rental income, for example, you can add all of these in there and give you a really good spread of what your possible return and figures might be for this buy-to-let property. Okay, so we're looking at a purchase price of 100,000. That's primarily for easy numbers. This is obviously going to vary where you are in the country. Usually, it's not always the case, but usually if you're paying more for a property, your yield will probably slightly reduce. Although your rental income will go up from a cash value, the yield usually slightly reduces because it's not a straight line in effect of how much the property purchase or the property value is compared to how much rental income you'll get. That usually starts to tail off as you go up in increasing prices. So if you want to hit a particular rental income or hit a particular rental yield, you might have to adjust the locations and or adjust the purchase price that you're paying for a property. Okay, so what we have here is a couple of different sections within this buy-to-let sheet. So property purchase price, 100,000. Then we look at the actual buying costs. So the acquisition cost for this property, we've got stamp duty, any sourcing fees, so if you're using an external company to help you find that property, legals, so your buying costs, conveyancing. £1,000 is generally top heavy for most buy-to-let properties. Obviously, again, it depends on where you are in the country. Your conveyancing costs for a freehold is sometimes slightly lower than what it might be if it's a leasehold property. But even for leasehold properties, and even including disbursements and VAT on top of that, you should still be below generally that £1,000 kind of budget. But that just gives you a nice kind of cushion. And you can play around with these figures however you want in the columns. So if we thought, okay, well, maybe it could be £800 or, oops, change that one. Say if it's £1,500, you can see how that starts to impact this column here, or this figure here, for purchasing costs. I'm just going to move this back down to £1,000 now in this example. Auction fees, if you're buying from auction, if there's any buyer's fees or agent's fees or anything like that that are relevant to the auction, you can add that there. Surveying costs, so if you're using a surveyor, and a mortgage setup. So if you want to wrap up any mortgage fees in this particular structure, you can add that as well. So that gives us a total purchasing cost here, as you can see, of about $4,350. Next, we're looking at refurb contingency, refurb management, and refurb costs. Now, anything here that is in a black border, that will be an automated calculation. Anything that's not got kind of a black border around it, that would allow you to tweak and amend those cells however you wish. So in these purchasing costs, that's automated. Refurb contingency, refurb management, they will be automated as well. And then the refurbishment costs here you can play around with. So in this use case for a 3-bedroom buy-to-let property, it's a semi-detached, we're looking to buy it for £100,000, do a nice refurbishment on it to add some good value. That's going to be, let's say, £25,000 refurbishment here. You can tweak these two columns, but ultimately if you've got a refurb contingency of about 10%, it's going to give you a refurb contingency here of 2,500. Now, if we change this to 15%, you can see that figure changes. And or if we change this refurb budget, so let's say to 30,000, you can see here the contingency changes again as well. So nice and simple and all automated for you. Refurbishment management. Now this is important to consider if you're using a project manager to oversee any of your refurbishments. And that could range anywhere from 5 to 15% of the refurbishment cost usually, depending on the level of skill and or work that the project manager is going to be doing on the refurbishment. And then you've got your total investment cost. So this total investment cost really is looking at all of the costs to physically buy the property in terms of your purchase, any buying fees, and then also any refurbishment costs. This allows you to assess the deal like for like against any other potential buy-to-lets that you may be considering. Next up below, we've got assuming it's a vanilla buy-to-let, then we're going to be looking at the rental income and how this impacts and plays out for your yields and returns. Now there's lots of other calculations you can add into these sheets, and we do add more calculations in when it's a more complicated type deal. So for example, HMOs or serviced accommodation, you'll see different figures and different calculations that we're ultimately looking to try and achieve, but they're all specific to that use case, they're all specific to that strategy. We don't want to overcomplicate it just for the sake of doing that, so we try to keep these sheets relatively simple. That's both important for us when we're assessing deals and also for clients when we've got clients that are considering projects as well. And we've gone through lots of different variations of these sheets. We've had sheets that have had at least 3 times, 4 times the amount of data on them we currently kind of have on these sheets right now. The downside to that is it just fundamentally makes the deals very difficult to assess quickly, and speed is very important when you're considering projects. And these forecasting sheets are primarily meant to ultimately just assess a deal, see if it's viable, and then see if it's even worth viewing, so you can use this pre-viewing stage to ultimately shortcut the amount of time that you spend on physically needing to go out and view properties. That's very important, especially if you're travelling out of area. It'll save you a lot of time if you do these sheets prior to physically viewing. And or they can be used after viewing. Once you've got a bit more context on refurbishment costs, you can also use it to understand really if that deal does make sense and does start to stack up. So on here, all we're now looking for, once we've got the understanding of the total investment costs, we just now need to understand what the actual potential income could be for that buy-to-let. So here you've got monthly rental income, £800 is assumed for this property in this location. And then the rest of the columns are all automated apart from this management fee. Now, tenant management fee we've set here at 12%. This will vary depending on where you are in the country, and it varies depending on the value of the properties. So some investor clients, when they are working on properties outside of their local area, they try and compare the management fees for their local town compared to management fees in maybe the area and town or city they're looking to buy properties from. Now, there is a big downside to that. If you consider a low value property that's maybe got a rental income of say £500 a month and the management fee for that is 12%, then the letting agent is going to be charging circa, let's say £60 or so a month to manage that property. Now, on a percentage, that might seem high. It might not, but it might seem kind of high to some, especially if you're based in London and your management fees are maybe 6, 7, 8% to manage a property. But if you compare that to the value of the property, if the rental income on that London property is say £2,000, then surely a 12% fee on that is going to be excessive and not required. But if you were to look at maybe a 10% or an 8% fee on that, that is way higher still than the management cost from a cash value that a letting agent would be receiving as an income if they were only charging, say, 12% still, but on a lower value rental property. So I hope that makes sense. It's important not just to compare the percentage that a managing agent is charging. If you are looking at comparing different areas, especially if it's not like for like, if you're comparing an area of higher value to an area of lower value, before you make a decision on the management fees. Where we're based in the Northwest, our management fees locally will vary usually from about 8 to 10%. Some agents will charge around 12%. We typically achieve 8% if we have a managing agent that's managing a number of properties for us, and usually around 10% if it's an agent that's just managing 1 or 2 for that given area. That management fee then will also impact here your total rental income. So monthly rental income per property here, 8%. Next calculation that we're going to be looking at is 2 figures. It looks at C5 and cell C21. Now, cell C5 is this rental income. Cell C21 is this total investment cost. So your average buy-to-let percentage that's creating here for you is based on all of your purchasing costs, not simply the purchasing property value, but also your buying costs and also refurbishment costs. And they're important to take into account because they will vary per property. So comparing, let's say, 2 properties that you can buy for 100,000, but one needs a significant refurbishment, you need to factor those figures in to give you your true gross rental yield. Also calculates management fees, gives you the management fee total there, so you can see a snapshot if you wanted to what that would be costing you. Monthly rental income per property minus management fees, and then your average rental income minus your management fees as well. So you can see here these 2 main sort of figures. Now, as you said earlier on, there are extra layers of information you can add, but for a straightforward buy-to-let, the main information that will help you assess deals quickly will be the gross rental yield. That will allow you to understand if those properties work for that given area. It will allow you to see if those properties work for your given criteria. You will have extra costs on top of management fees, things like insurance, other costs potentially like mortgage, any maintenance costs as well for the ownership of those properties. That will all vary based on the property. It will also vary on each individual, depending on if you are taking out mortgages and also how much you might be taking out in terms of from a loan to value perspective. So we don't need to overcomplicate it. As we said, let's keep it simple for the buy-to-lets. Just look at gross rental income, and that will give you a very good standing on how to assess your potential income. If you wanted to try and see what your net income would be, not taking into account mortgages, as a very general rule of thumb and a guide, we usually look at about a 1 to 2% spread for vanilla buy-to-lets between the gross and the net rental income. So if we're assessing a deal and it's got a gross rental income of about 8%, we would usually be seeing a net rental return on that property year on year of about 6%. That takes into account things like voids, management fees, maintenance, insurance, the running costs effectively of that property, assuming it's a well-run kind of property. So that gives you some context. It's usually anywhere from 1 to 2%. So as a guide, you can say, let's say 1.5% difference between that gross rental income and the net rental income. Hope that helps. Any questions on how to forecast and assess a potential buy-to-let deal, let me know. Happy to help. And in the next videos, we're going to be looking at the other strategies and forecasting those deals as well. Actually, just to kind of finish off on this particular video, to go through the flip sheet for you. The information here, again, is all pre-populated. The only thing that you have to change potentially would be your assumed property sale and valuation. So you've got here property purchase price, purchasing costs is formatted from the original sheet, same as your refurbishment, same as your total investment costs. Resale costs, that assumes an average 1.5% for most estate agents if you're using a local high street estate agents. There are a lot of estate agents now charging less than that, around 1%, and you can also get online estate agents that's charging less than that as well. But you can obviously affect and impact those figures and those calculations in these cells here if you wanted to. Property sale gives you a total property end price and then profit on that sale as well. So it gives you an idea of what you would achieve if you were to sell that property post refurbishment. So very quickly, this property looks at about £100,000 purchase, about £25,000 refurbishment, and you're assuming maybe a resale about £150 after all works. You're probably talking about £15,000 profit on that particular deal. Hope that makes sense. As always, any questions, don't hesitate to ask, and look forward to catching up with you shortly.